So for a lot of homeowners, equity is the biggest financial tool they've got. It's basically the part of your home you actually own, and for a lot of people, it's just sitting there as untapped value. And if you're looking to actually use that value, whether it's for renovations, paying down debt, or handling a big expense, there are a few different ways to access it. You've got the standard routes like a home equity loan or HELOC, and then there's a newer one called HEI that's structured more like an investment. So in this video, I'll break down how each option works, who they tend to suit best, and what the trade-offs look like so you can figure out which one might be the best fit for your situation. So starting with the most familiar, home equity loans, or HELs. These are basically second mortgages. You go to a lender, they check your equity, credit score, and income, and if all looks good, they offer you a lump sum of cash. From there, just pay it back over time with fixed monthly payments. And that fixed rate is why a lot of people go for this option. You know exactly what you're paying every month, which makes it easier to budget around. The terms usually run between 5 and 30 years, and it's a good option if you've got a specific expense you're planning for, like upgrading your kitchen or consolidating some higher interest debt. You'll need a decent credit score, usually 680 or higher, and lenders want to see you built up at least 15 to 20% equity. Of course, this is still debt, and since your home is the collateral, missing payments could eventually lead to foreclosure. So you really want to be sure those monthly payments fit comfortably into your budget. Now, if you don't need all the money on day one, a HELOC might be the better choice. That's short for Home Equity Line of Credit, and it works kind of like a credit card, but backed by your house. You get approved for a credit limit, and during the draw period, which usually lasts 5 to 10 years, you can pull from that line as much as you want. A lot of HELOCs let you make interest-only payments during that draw phase, and then once repayment kicks in, you start paying back principal and interest. Since most HELOC rates are variable, your payments are going to fluctuate with the market. The flexibility is nice if you're not exactly sure how much you'll need or when, but it does come with a little more financial unpredictability. One other thing to keep in mind, if your home's value drops or your financials change, your lender could reduce your limit or freeze the line altogether. So while it's handy, it's not totally risk-free. So that brings us to the newer option, home equity investment, or HEI. And one company offering this kind of product is Point. Now, because it's not a loan, there's no interest rate and no monthly payments. Instead, Point gives you a lump sum of cash up front, and in exchange, they get a share of your home's future appreciation. You stay the full owner of your home, and you don't pay anything month to month. Repayment happens later, usually when you sell your home, refinance, or decide to buy back their share. You got up to 30 years to do that, but there's no penalty if you want to settle early. What makes this a great option for some people is that it doesn't rely on your income or credit the same way loans do. Point works with credit scores as low as 500, and there's no strict income requirement. It's a lot more accessible if you're retired, self-employed, or just going through a transition in life. If you're curious how it all plays out, it starts with a quick online pre-qualification. It takes about a minute, and it uses a soft credit check so there's no impact on your score. If everything checks out, they'll order an independent appraisal to figure out your home's value. Now, here's where it gets a little technical. Point applies what they call a risk adjustment to that value, usually around 27%. So if your home appraises at $500K, they'll treat it as $365 when calculating their share. It's meant to protect them from market dips, but it does increase the share of appreciation they get later, which some folks can see as a downside. Then at closing, there's a 3.9% processing fee, minimum $2,000, and the standard third-party costs like title, escrow, and appraisal. Those get deducted from the cash you receive, so you're not paying anything out of pocket. From there, you're free to use the money however you like. No payments and no interest ticking up in the background. Now, when it comes to repay Point, it's got to be done as a single lump sum. That could be from selling your home, refinancing, or just paying it off directly, but you can't do partial payments, so you'll want to plan ahead for that. But they've got a nice way of protecting you from market downturn. If your home's value ends up lower than what it was at the time of the investment, Point shares in that loss, so you could actually pay back less than what you received if things don't go the way you'd hoped. There's also a protection cap that limits how much you might owe if your home sees big gains. It uses an annualized percentage that compounds monthly, and it's built to keep things fair if the market really takes off, especially early on since the starting point sits below your appraised value. There's also a repoint option that lets you refinance into a new investment if you want to pull more cash later, and if something happens, your heirs can always take over the investment instead of settling it right away. That gives your family some extra flexibility. So when you stack up all three kinds of options side by side, it really comes down to what kind of flexibility or predictability you need. A home equity loan gives you fixed monthly payments and a lump sum you can count on. It's straightforward, it's budget friendly, as long as you qualify. A HELOC lets you borrow as you go, which can be helpful for longer projects or uncertain costs. But the variable rate means payments could rise and there's a bit more to manage. And then there's the home equity investment model from Point, where you don't have to worry about monthly payments or interest, and the approval process is a lot easier. You do give up a share of your future appreciation, but in return you're getting more breathing room for now. And if that HEI model sounds like it might work better for you, there's a link in the description with more details. We usually have some affiliate offers there that you won't find on the main site, so feel free to check that out if you're interested. So hopefully this helped you get a clear picture of what each option looks looks like and what might be the right move depending on your goals. If you found it helpful, I'd really appreciate a thumbs up. And if you got any questions, feel free to leave them in the comments. I try to get back to as many of them as I can. Thanks so much for watching, and I'll see you in the next one.